Welcome, everyone. I'm Angelo Robles to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. Today's podcast, real estate and the future of cities. Will they recover? Now, the conversation's actually going to be very broad, covering a lot of different topics in real estate, but given some of the challenges, including as a society that we're going through now, I know this is some of the questions that families are thinking about. And I myself, being in the greater New York City area, so we have a lot to discuss with our special guest today, and really a topic that has been gravely impacted, and I mean at the top of the food chain, with COVID-19, and again with some of the civil unrest occurring. Our special guest is DJ Van Keuren. He's the founder of Family Office Real Estate, known by the acronym FORE, F-O-R-E. I've known DJ for a number of years. He headed up real estate investments for a couple of very prominent and rather eclectic single-family office principals in the Rocky Mountains as well as in Beverly Hills. So DJ is someone that really, he's completely immersed in real estate. He has deep experiences inside a single-family office and from other perspectives as well. And I look for this to be, although I know DJ, we're probably going to have some disagreements, and that's good. We want to make it a exciting dialogue for you, and you all know the drill already, but I can't always comply, but I'll try. My live audience, feel free to use the chat feature, but please stay off video and muted. It just makes it a better recording. On that note, DJ Van Keuren, how are you, DJ?
I'm good, Angelo. Thanks for having me.
Well, thank you. Well, to give a little bit of context, you're someone who goes back with a heritage in this country from Europe, Dutch, I would assume, into New York in the 1600s, and right. Reminds me of your early family heritage. And, you know, we all know the story about the Native American Indians selling for what, like $12 Manhattan. So early on, your family was one of the true real estate empires going back, 400 plus years ago. It's amazing.
Yeah, correct. In fact, the Dutch West Indies Company were the ones that bought it from the Indians. And it was right around the dollar amount that you mentioned. And there were 7 different partners. And my distant relative was one of those 7 people. And so we actually owned from 83rd all the way up to 133rd east and west. So a pretty significant amount of the island.
Wow, that's amazing, I would say so. And real estate is certainly an investment that over time has been incredibly successful for a lot of families. It's actually created a fair number of families that have done so well to create their own family office, some that you have worked with. Mm-hmm. And if I could call it an alternative asset class, it's probably by far the most common alternative asset class, other than what, cash, treasuries, and public securities, that a family of success and a wealthy family is going to own. So it's going to be important to get intellectual capital relative to that, especially for the reasons that I noted earlier. And let's just jump right into it. We're in the midst of COVID-19. This is having an impact like we've never seen before in real estate, at least in my opinion. And coupled with some of the social unrest, mainly in inner cities, that we've had in the last couple of weeks. And again, completely understand the murder of George Floyd. And you certainly have protesters that in their heart are doing the right thing, and that's true. But there's also going to be an element relative to rioting and theft that is unacceptable. But this is creating grave challenges and possibly going to cause an earlier second wave of COVID-19 relative to people in proximity. So you have a couple of a 1-2 punch here. Why don't we start in the heart of it well, what I think is the heart, my backyard, New York City. DJ, I mean, I talk to a lot of families, I hear different perspectives, but I would be gravely concerned that we're in a situation now where New York is an epicenter of the world, along with London and some communities. And what's happening for the reasons that I noted and the impact of real estate. And then we're going to get to regulation and taxes, which are bound to get worse in New York City. But why don't we lay the groundwork for your opinion, what you're seeing and hearing about the impact of real estate in New York City?
Well, there's a couple things. You know, the obvious and area in New York is going to be the office space, right? And are people going to come back to the offices or not? You also have some questions on the retail side, and you do have people that are going to be leaving the city. There's already an outflow of people that have continued over the years, go down to Florida, for example, because of the taxes, or live outside the city. So are we going to see a major impact in New York? We are. One of the issues is that it's one of the few cities in the world where you've got people coming from all over the world. So that makes New York quite different and than many other markets, because it's just not people moving, for example, to where I am in Denver. You are going to get some international people that are moving here, but not to the extent of New York. So because of that, you're always going to have a pretty good base and continual people that are coming in New York. And so I think short term, I've talked to some families before too that don't feel that the office sector is going to be as impacted as much long term. But retail for sure, but you always have turnover of retail in New York City anyway.
Yeah, I mean, you hit upon the two that are probably going to be on the surface impacted the most, and that would be office and that would be retail. There's the changing dynamic of the Amazon effect that has been gravely impactful to retail and broadly technology and AI. And everything that was going to happen, like I said yesterday with Peter Diamandis, it's a common phrase, but I'll repeat it. Everything that was going to happen is being sped up now relative for the reasons that I noted. So if I'm a current investor in office and retail space in New York, I, for sure, short term and whatever, now through the next 2 or 3 years is going to be impacted. What do you do to adapt the space to be creative that could work in a new normal? Is it possible to take certain office and retail space and have more tenants in a smaller area? What could you do to potentially make that work?
That's a good question. I mean, and once again, we don't know what's going to happen necessarily with the impact. And we are going to find out next 2 or 3 weeks if COVID's going to have a second cycle because of the hundreds of thousands of people that have been protesting, right? So they've been right next to each other. So I think unfortunately, it's going to be a really good test to see where we end up. But, you look at the possible repurpose of some of this office space, right? You could take a couple floors, maybe you put a school in there, maybe you utilize it for, some type of apartment per se. I mean, you could reconfigure it. The biggest thing about New York that people don't understand is that the average time frame that somebody holds onto a property and exchanges a property in New York is 25 years.
Wow.
So a lot of those retail shops, right, are in the first level. And then above that, you've got apartments. And I'll just use that as one example. So they charge so much at that retail level. In fact, I think Tiffany's was paying something like $50,000 a month. I mean, a pretty considerable amount of money. And a lot of these places too are spending 10, 15, 20,000. So they've already been vacant and there's been a tremendous amount of turnover. When I lived in New York on the Upper West Side, I mean, we'd see retail change hands all the time. And a lot of places actually stay vacant. But once again, going back to how long these properties have actually been held, they don't necessarily need to worry about filling that space on the first floor.
And so I spoke to 2 prominent families in the last week relative about New York. And in theory, this could apply to LA, Chicago, and other big cities, but a little bit more pertinent to New York. And they were both very different opinions. One opinion was, this is relatively short term. New York has amazing as an epicenter of culture, of the world of finance, of universities that younger people prefer to be in more urban areas. And again, every one of those comments, perhaps some of it has shifted via COVID, but on the surface is accurate. So actually, yeah, finally, I could buy into New York, maybe not quite yet, but soon, the coming weeks and months, at a bit of a distressed opportunity, knowing that although it may not bounce back in 18 months, but likely it's going to be a good outcome if I get the right price I want for the reasons that I noted. That was option one. Option two, by a really smart person, New York is screwed. It's in really, really bad shape. It's overly concentrated. Public transport is difficult now during COVID, second wave, suppose another virus hits that's like this. And then you're going to have burdensome regulation, and taxes are going to get worse and worse. And Florida and Texas and other communities are starting to look better. And if you're in the world of finance, do you really need to be in New York City anymore? I wouldn't say it hurts, but I don't know if it's an added benefit anymore. And then the big one, a lot of the white collar industries have been remote for the last couple of months, and it's kind of working. And the second biggest expense of most companies after people is going to be real estate. So this person was very, very bearish, basically telling me they wouldn't even buy at a distressed price. They were very negative. Option one, option two, or somewhere in between. What are you seeing, and what do you think is going to happen?
Well, I was in New York during the recession, and that's when you were really buying properties at quite a bit of discount. I mean, you could buy a property and not do anything to it, and you would have made probably tens of millions of dollars. New York is an epicenter, just like you said. You're always going to have people moving there. California is another state where there's actually more people moving into the state than leaving the state. And, once again, you also have people that are coming from around the world that are able to be there. So I think, are we going to see some type of distress? I mean, that's still open. It's only been a couple months, right? And so I don't think we're going to see too much of a change per se. Of course, we're going to find out too with what goes on with COVID. But I think that long term, New York is just going to keep moving forward. I think you've got Hudson Yards that are coming up. It's going to attract a lot of people. Brooklyn's really taken off over the last number of years, and the last place to really be taken advantage of is up Harlem, going up toward Washington Heights. That's the sort of last wave that's going to be happening.
Yeah, so, like the Inwood section. Sure.
Yeah. So I think that New York is going to be, I mean, there are New Yorkers that are like, I grew up here. I'm never leaving, And so I think that if there is an opportunity, it's just going to drive more people there. And regardless of taxes, you're going to have people that are continuing to move there. So long term, I just see continual growth happening. And once again, primarily because you're not just pulling from U.S. citizens, you're pulling from people all around the world.
That would be a very logical conclusion, and we noted all the reasons why. The universities, younger people that are educated from universities preferring to work in an urban environment for social aspects as well, and being so international. But I'm also, sometimes I flip-flop and feel it's over. And I think taxes are just going to get incredibly burdensome in New York City. They're not exactly pretty in California as well, but New York City is in its own. And here's one thing I am seeing. So I'm in a suburb in Fairfield County, Connecticut. We are seeing a tremendous amount of people, and those in Long Island and Westchester and Northern Jersey may be seeing this as well. It's a great time to sell if you want to go to Florida now, because it's selling like that in Westport, Connecticut, in New Canaan, in Darien. And these are people that are living in a $1 to $2 million pad in New York City, and like, wow, I could get away from the fray. I could work remotely, and I'm getting what, like an acre or 2 acres and 4,000 square feet. So, I don't know. I could make that argument either way.
But where were what was happening 4 months ago in the real estate market in Connecticut?
It was actually going through some struggles.
A tremendous amount of struggles where people were leaving like crazy, and there were all these properties. So what's happened is that there's huge demand, right? So people are moving to Connecticut, and 4 months ago, this was a whole different conversation. So if there is a downturn that's going to happen on the real estate side for on the residential component, because of the prices are down, you're going to have other people that are going to be coming in with the same philosophy as going to Connecticut, but coming into New York because they can buy at a better price, right? And so I think that you have to take, once again, 4 months ago, people were like, everybody's leaving Connecticut. Well, now they're coming in. So it's just a matter of where are we in that stage. And this is really unknown. I mean, I didn't expect to see a recession coming through based upon, 250 years of data from the US, Australia, and the UK. We're supposed to hit a recession around 27, 28. And this is an unknown. This is a black swan, which personally I don't think is going to be a black swan in the future. I think that this is, we were very fortunate to have the outcome that we have with COVID. I think we're going to see something much different and much more powerful in the future. But we've never been through this. People just know that they remember the recession and that there were opportunities, and it's still in the forefront of their mind. And so people are looking for those opportunities. And right now, Connecticut is one.
When I drove through New York, and this would apply again to the other cities, I felt it in my heart from multiple different ways, understanding what it's like to be a small business owner and looking at bars and restaurants and many of these companies where 30 to 50% of them, in Angelo's opinion, in New York and other communities, are not going to come back. And then what is the landlord going to do who's not getting rent? Let's just say it's a restaurant or bar configured as such, but no one's going to want to jump right in there, given potentially a second wave later this year. How do they completely reconfigure the space to get a new tenant? I mean, this sounds messy, DJ. I don't have any answers for this.
Well, there's two things. One is, like I said before about New York, is that the average hold time is 25 years. A lot of these people are willing to just have it vacant, to wait for things to come around because they can, because they probably don't have a lot of debt, and they're getting rent from above, right, for the apartments. So in New York, you're going to have a lot more people are going to be a lot more patient and be able to be patient. Where the problem is going to really fall in is exactly what you're seeing in other parts of the country, because retail was a great opportunity to invest into. If we were talking a year ago, I'd be like, look, there's an asset class that people aren't really taking seriously. You can buy for a 9 or a 10 cap, which is great pricing. And these are going to be lifestyle type businesses where you can't get a cup of coffee online. You can't get your hair cut online. You can't go work out online necessarily if you want a full gym experience. Well, now these were all hit by COVID. And I think we've got a bigger problem outside of New York with all of these small businesses that are not going to be coming back. And let's also remember that these are people that employ people too, right? So one of the comments that I had, I was doing some work with the third gen Monforts. They own the Colorado Rockies, and they had bought 3 businesses for the real estate, right? One near the baseball stadium at Coors Field, and they had 2 others. And the plan was to either sell off those 2 properties, shut down the retail component, which was a bar and restaurant. And I talked to him one week into COVID, and he's like, we close these down and they're never going to open up again. Now that was part of our business plan, but that was a year or 2 years in the future.
Yeah.
So what about all of these people that have these retail jobs, and there's not going to be any opportunity? I think that's a bigger problem. And then what do you do with that real estate to repurpose it or find tenants? Because right now what's happening is that you've got people that are going through where they're only getting 30% of the rent on the retail, and they're having to negotiate some type of a payment plan where maybe it gets pushed to the back of the rent, of the lease, or they're also negotiating with the lenders on how to handle this problem. And believe it or not, Nordstrom Rack actually came forward to a person that I know and said, we're not paying for a year. So, I think there are bigger problems outside of New York just because these are more legacy assets in New York than in other parts of the country.
I was going to get to that, but I was already negative enough. I don't know if I wanted to keep on pounding that. Let's talk a little bit about opportunity. Now, the opportunity, arguably, and this is what, again, it's a bit of a sensitive subject, is going to be people with resources, with money and liquidity. To some degree, experience and guts. And that's going to be during a time of turmoil where potentially there's distressed opportunities. It's an opportunity to be a buyer, to be strategic, to be tactical, and look at it as, well, I'm going to get a discount. And like you said, I don't need it to turn around in 2 or 3 years, although maybe not 25, but maybe I have a 5 or 10 year time horizon. So how would you suggest that families with the resources go about as a direct investor or through many of the funds that are popping up now for distressed opportunities in real estate?
Yeah, so, I've spoken to a lot of families, and what was interesting is that when COVID happened, all of their focus went to their securities portfolios, right? Okay, what's happening? Where are we taking a hit? Because it's happening real time, right? Whereas real estate is you don't have that liquidity feature unless you own a REIT. So all the focus went to how do we take advantage of the market. The other money of any of the real estate, and families are still planning on moving forward, is distressed. Now, what happened in the last recession is a lot of the families were holding off and saying, okay, I'm not sure what's going on. I'm worried about investing money, and really missed out on a lot of that opportunities where there was distress during the last recession. The memory is still there. And now the attitudes with families are really saying, okay, we're going to take advantage of it this time. We believe that there's going to be distress that's coming. And so let's wait until we find that distress, which is much different than what happened, as I mentioned, during the last recession. So they are looking for opportunities. Where are the opportunities going to come from? Hospitality is the number one area, right? There's going to be a lot of hospitality. It's already starting to happen where some of these owners that own a number of properties are thinking about bankruptcy, or they're not being able to ride the storm. So hospitality is going to be the number one area, and it's going to be primarily those types of properties which you're looking at, like a Fairfield Inn. You're looking at a middle market Marriott, Courtyard by Marriott, right? And these are properties where they're not going to have to spend, people aren't going to be spending the type of money as they were in the higher end hotels. And that's what's going to take off initially. The second area is on the retail side, like you said, and there's going to be some opportunity to purchase some good retail. Once again, it comes back to location and what is already in place. And then third is on the debt side. The CMBS market totally froze after about 4 weeks of what happened or going into COVID. And they have a problem because of how those are structured, where they can't really restructure them per se because of the parties, all the different parties that are involved. So there's going to be opportunities on the debt side in order to, make some acquisitions in that area. So those are the three main areas. I don't see necessarily multifamily becoming a distress. However, one of the biggest things that people need to realize is that multifamily follows other types of real estate by about 9 months. So you're not going to notice that there's problems that are happening within multifamilies until later down the road. Also, Fannie and Freddie came forward and they gave some relief to about 27,000 owners of properties with the debt, and they did that relatively quickly. So you've got relief that happened on the rent payment side, right? And then you also had relief that was happening on the debt side for these multifamilies. And so once again, we're not going to see some type of a shakeout. However, what you do have is workforce housing is considered recession proof. Back to what you brought up about retail, workforce housing, it has and houses a lot of these people that are working at that retail level and the blue collar level, and they're definitely going to see some challenges.
Why does multifamily housing lag other aspects of real estate by 9 months? What's the reason why?
Well, that's a good question. And the reason why that happens is because you won't see the outcome for about 9 months due to a couple different factors. One is that, there's a certain period of time before they start that whole eviction process, right? You miss 1 month, they're not going to say you're out. They're going to say, okay, you're behind. So when do they actually start that eviction process? It could be 3 to 6 months later.
Sure.
And then once that eviction process started, it could take a number of months before you're actually saying, okay, we're shutting the doors on you. So you're not going to see real impact and where things stand for actual payments happening until after they go through that process of notices and non-payments and then eviction.
And I'm glad you mentioned before, we're going to spend a little more time on multifamily in a second, but you mentioned hospitality because the average person's going to look at that and say, oh my God, that's getting crushed by COVID. But again, for families with wealth and resources and liquidity, possibly experiences and guts that I mentioned as well, that's potentially where some of the distressed opportunities are going to be. Whether a family is going to be more active as a direct investor, depending on their experiences in real estate, or probably the safer approach, but potentially less profitable coming in through a fund. But those opportunities, they are going to be there. The COVID-19 is not going to last forever. The economy's been shockingly better than anyone would have expected. Now, again, there's lots of things that could go wrong, from inflation to a second or third wave of COVID, the vaccine taking longer than expected. There's lots of things that could happen, which is, again, it's not a sure thing. It's not buying into a treasury. But certainly I'm seeing families internationally that are very interested if they get the price they want, which is, part of the challenge. So since you did focus on multifamily, let's look at the statistics. The statistics would basically be that more people are renting, millennials are getting married later, they have less kids, younger millennials are gravely concerned about the future, so potentially committing to a home. In other words, especially for those under 40, home ownership is going down. Part of it played into more the urban communities and renting, although again, with COVID, that may adapt and shift a little bit. So you would think, as you said, now the 9-month lag plays into it, that multifamily housing may be a good real estate play even during COVID. However, the one variable in that is people not having the money to pay their rent.
Correct. So the biggest things we have to understand is that the fundamentals are staying the same. So you look at Denver, where I am, for example, and what are the key drivers to all these areas that have been growing, whether it's been Seattle, Austin, Salt Lake City, Boise, Nashville. It's because of cost of living, quality of life, and where the jobs are, right? So as things starting to happen again in the employment sector, there's still going to be a need for people to go where the jobs are. There's still going to be some of the aspects that you brought up with the millennials and getting married later. You're also going to have quality of life and cost of living. And I think that you can make a case to actually say that some of these cities, like the ones I mentioned, are actually going to have more people moving to those areas because they've realized that, okay, we didn't have a lot of money, and we've got to make sure that we're able to, recapture and get back to where we were. And the biggest expense that people have is housing, especially on the multifamily side. And so the fundamentals are still there. Where you're going to have an issue is going to be, like I said, I think on the workforce housing side, from the mere fact that it's all of those people that won't have a job to go back to. Now, I've talked to some owners of multifamily, and their rents have just been coming in at 85, 95%. And so they really haven't been a change. Now, does that have to do with some of the monies that were provided by the government so they could make those payments? Sure. I think that, once again, that's going to help with the lag, because we've artificially provided capital where you're going to find out what those occupancies really are once they're trying to go back to work and they can't get certain jobs. But, that middle market for apartments are going to continue to be there. They're going to continue to grow. And once again, I think you've got a lot of the same fundamentals that existed 3 months ago that are going to continue on.
And back a little bit to distressed. So it's gotten a little better with COVID, so more traveling. I have relatives that work in the airline industry. The planes are starting to feel, coming in and out of New York, a little bit more normal. So this may impact the New York investment crowd looking for distressed opportunities around the US a little easier than it might have been 2, 4, 6 weeks ago. But in general, for a family that wants to be a more local, regional player, be an active direct investor, and look for distressed opportunities, would it not make sense to have local relationships on the ground with banks and understand from them where there may be a distressed opportunity where they could come in at? How could families source more regional direct investments into distressed real estate?
You can go through the route of through banks. You can. There's a lot more work, a lot more heavy lifting than you actually realize. The best thing to do is to actually identify, a local operator. This could be somebody that you'd worked with in the past in those specific areas to work with, because they're the ones that are the boots on the ground. They're the ones that have the relationships already, and they know what's going on. The other thing that you have to take into consideration and truly understand is that, hospitality, yes, there's real estate involved, but the reality is that it's an operating business, and you can't look to go into that yourself without having that knowledge and expertise. And you really need to make sure that, that you vet the sponsors and the operators going to look at. And that's one of the biggest things that a lot of families, unless they made their money in real estate, or unless they have a platform in place, it's that due diligence. And now more than ever, they have to make sure that they're actually, scrubbing and doing the due diligence on that operator. Because if they've got a portfolio of hotels already, and they're like, we're going to go out and buy distressed, that's great. You have the experience, but what's happening with your existing assets, right? So you've got to dig one step deeper to say, yes, they have expertise, but are they upside down with their existing properties? So yes, you can go to banks, but I am a huge believer in working and investing with somebody that actually has that local knowledge, understanding, and local relationships. And most likely, if there are opportunities at the banks, they're the ones that are already ahead of you, and they've got those relationships already with those sources.
And again, it's gotten somewhat better relative with transportation and viewing, but let's go to the diligence aspect of it. COVID-19 creates challenges for those that really need to be, I need to see, feel, and touch it. So does it become more of simply a math decision where you don't have to do that? How do drones play into this, or simply local relationships on the ground that could do that for you and send you a summary and pictures?
Well, what I've come to find out is that the families that are investing with local operators, they're relying on those people to look at the properties. They're not necessarily going out there and looking at the properties themselves. They also heavily rely on referrals and from other families that might have invested with them as well. If they're going to do it themselves and invest in those properties, then yeah, they're going to have to go visit them and take a look at those and really dig into the financials. One of the biggest things that I think a lot of people were missing before is that anybody could have made money since 2009. And so you have a lot of operators that have shown, hey, we've had a 30% return, a 35% return. Well, yeah, but that's only been in the up, during the coming out of the recession. This shows again why it's so important to try to find partners that have been through multiple cycles, because they're probably positioned already, ready to go, and they're looking for the opportunities because they know that how to handle it, how to do workouts and stuff like that. In fact, the first patriarch I worked for, who Marcel, he was actually sitting on 250 million ready to go for distress, and he had this beforehand. So he's been through this 3 times before where there's been distress. Now, he's never been through a black swan event, but he was prepared for this. And I guess that's the point. And that's why it's so important that you partner with people that have that extensive experience.
On the city front, we primarily focused on New York and covered some other topics. And you said, again, maybe some of the suburban and rural areas, potentially more so on the employment aspect, could be hit even harder. And that may be impactful relative to single family homes. But I find the Bay Area, San Francisco, to be intriguing. It's nowhere near the size, people-wise, of New York, LA, Chicago, but it's an iconic American city. It's wickedly expensive. It's the heart of the VC industry, and they'll tell you that, easily their second biggest expense is real estate. It makes it difficult for talent not making hundreds of thousands of dollars to move there because it's so expensive. So the dynamic of remote workers is more diverse and intriguing now. But San Francisco appears to be a community. I mean, I think employers probably pay, I heard, a 30 to 40% premium just to have a base there because the expenses of living, let alone the office space, but the expenses of living for your people. So how will that community be impacted by what's going on? What are you seeing in the statistics?
Well, a lot of the people that you're talking about and tech related and being able to work from home, I mean, a lot will live together, just like in New York City, right? So the younger population will come together and they'll each pay a portion of rent because it's easier to pay $1,000 than it is $4,000 a month, right? So you're still going to have that. The people that have been in the market for a long time, there's no reason for them to leave because they got in at a lower price point. And I think that, you get a lot of people coming from Asia into San Francisco, and investors are always looking for the cities, where the port cities. So they're looking at the Miamis, the New York, the San Franciscos, the LA before they're willing to go into a Denver. And there's a lot of money in Asia and a lot of money that's looking to come out of Asia when they're able to. And that's going to continue to be a place where they want to invest, which is going to be San Francisco. So will it create some opportunities? Yeah, it very well may. But I think it was actually Facebook that was even saying that they wanted people to come in to the office still, even though they can go remote. If I remember correctly, I don't want to misquote something, but that's what I remember. It was a major tech firm that was still saying, even though you're able to be remote, we still want you in the office.
And besides multifamily housing, which possibly not a distressed purchase because, again, some of the numbers may look relatively attractive on it, but that's not the only type of real estate that potentially actually might even bump up in value now during COVID. Self-storage probably would be one. So, we covered to some degree retail, commercial, a pinch of single family homes, multifamily housing, but let's go into maybe some more esoteric type real estate assets like self-storage and others that may benefit during a challenging time. What would some of those be, DJ?
Well, I'll tell you what's really done very well is industrial.
Yes.
So industrial has done really well for that. And so that's definitely an area of interest, right? I'll tell you an asset type or a property type having to do with a specific industry that people, I think a lot of people and families were worried about investing into, and I think there's going to be a big jump, and that has to do with marijuana. There's a lot of, people who are worried about renting because it's a cash business right now, and they couldn't use, put money in banks and whatnot. And that in California, here in Denver, was considered a necessity. So you had people going in and actually, they didn't lose business, they actually increased their business. So real estate where there's, a necessity for people to go. So marijuana, it was one of the areas. Self-storage is typically based around, renters, right? And people
Yes.
that need to be putting information, putting there. So as that multifamily continues to grow, self-storage is going to continue to be in demand. Believe it or not, what else did very well was like 7-Elevens. And 7-Elevens, even though the gas price came way down, their margins went way up. So they were actually able to hold themselves through this whole, pandemic. And so industrial, there is some self-storage opportunity there. Triple net properties that have corporate guarantees. And of course, that also goes into pharmaceuticals, right? So Walgreens, CVS, still need to get your medicine, just like you need to still go for your dialysis. So it's a lot of those types of properties that house these types of opportunities.
Those were excellent tips relative to, again, real estate that not even necessarily distressed, that potentially could benefit from some of the challenges that we're seeing now, and how multifamily office ties into self-storage. Certainly what you said about pharmaceuticals, about manufacturing, probably starting to make a return back here to the US for supply chain reasons, which we'll save for an economic discussion, but appears to be the trend, and really good on cannabis. So some of you that are listening in live, we had a cannabis session 2 weeks ago led by my former president, Ryan Anson, and some of you said it was the best cannabis session that you've ever heard. It was really, really good. It is up on my YouTube channel now. That simply is Family Office, or if you send me an email, I'll forward you the link. But Ryan is a brilliant thought leader, and his two guests were amazing. And you're correct. That's going to be an intriguing business for tax purposes and other reasons why, and how it impacts in real estate as well moving forward. One of my members, he might even be on the Zoom now, I think he is, he was kind enough to send me something that I shared with you this morning from the very well-known writer Paul Sullivan at the New York Times, basically talking about 1031 exchanges and opportunity zones. Now, we are covering tomorrow a full hour dedicated to opportunity zones, so we won't go, super deep into it now, but I felt it was an excellent article, and I know you had some strong opinions and thoughts about it. I'd love to hear it.
Yeah, so what amongst a lot of things that Congress did is one of the changes they made was to extend the amount of time that people could look for 1031 exchanges. So they sell their property, they don't want to pay capital gains, and so you're given 45 days to identify a property, and 3 properties, right? Minimum 3 properties. And so after that, you've got 180 days to invest that capital. Well, they pushed that out to another 45, 60 days. And because of that, it caused a lot of people to be able to have more time and sit back to say, okay, what opportunities are there out there? And then if they were about to close on a deal, in that article that you mentioned, it was somebody that was going to close on a hospitality, a hotel, right? And so a lot of times people will go through and they'll be like, oh my gosh, we're getting to the 45th day. I just got to find something to invest. So what's happened is that there's actually been investors that have pulled back. And in that example, they're like, hey, I don't have to invest immediately in this hospitality. We know that we're taking it, that there's a hit taking on the hotel side. So I'm going to pull back and wait. So there's been deals that haven't been consummated because of this extension that was provided, which is one thing. Also, you have the issue where there's not as many transactions that are happening, which causes a challenge for the 1031 people. Even though it's been extended, they have less choices per se. And what I believe is going to happen for two specific things that are going to happen because of what's happened, because of the extension of 1031, and also because of what's happened in the stock market. A lot of families were very active because of what was happening, right? Like I mentioned at the beginning. So there's going to be capital gains there. And 2 years ago, we did a study through the Family Office Real Estate 4 as the largest of its kind, 55 questions to families. And at that time, 17% of the families said that they were going to invest into opportunity zones. The remainder were either no or yes. This year, it ticked up to about 19% of families that said they were going to invest in an opportunity zone. Well, if you don't do a 1031 exchange and you want to defer those capital gains, guess what? You can do that with these opportunity zones. And I think what we're going to be seeing is that there's going to be a lot more money getting invested next year into opportunity zones because of what's happened with this 1031 extension and not having a lot of opportunities, and then the sales of stock portfolios where there are capital gains that they're going to want to defer. And so I think we're going to see quite a bit of uptick because of these two situations into OZs going into next year.
Very good advice. And again, a reminder, tomorrow we have a full hour plus with a really intriguing, actually they're a family office. They're active in terms of opportunity zone investments, and they launched a publicly traded opportunity to be involved in opportunity zones via a REIT. So again, if you're hearing this in a podcast or YouTube, it'll be too late, but you could hear it in when that comes out as a podcast or my YouTube. But for my live audience, you should have gotten the invite. If not, you'll get it after this. But if you're interested in real estate, that one's at 2 p.m. tomorrow. It's kind of hard to imagine that you're not going to be interested in that discussion because it's so unique. DJ, a little bit about what you do, because you could be of tremendous help to successful families and family offices, not what they fund to offer, but effectively as a private consultant, helping them navigate what, again, often other than their more liquid portfolio is probably their most common alternative asset class. I'd love to hear a little bit about what you do. And please, everyone, DJ also has a podcast. Please say what that podcast is. I recommend that you subscribe to it. It's great. And talk a little bit about your magazine as well.
Yeah, so we've got, as you mentioned, I've worked with a number of single families, some prominent families in the past. I've always gotten phone calls, ask questions from other families, which I'm happy to help, and I'll do anything that I can to help. And that's always an open invitation. But one of the first things that I found out when I started in the family office space and really started researching is the need for education, which is another comment I want to mention, and I'll come back to this because the content you have and what you provide, Angelo, is absolutely amazing, and it's the best that there's out there. And so I'll come back to that here in a minute. But there's a podcast, Family Office Real Estate Podcast, which is similar to what you're doing with the focus on real estate, right? To talk to industry experts. There's also the news network, which is just like this, which is interviews with industry experts talking about various aspects of real estate, specifically to family offices. There is the Family Office Real Estate magazine that is comes out on a quarterly basis, and that goes to about 1,000 families directly on a hard copy. And then we just increased our distribution to about 165,000 on the electronic side to get that out there.
Wow.
And the consortium was the first educational event that we did just with a handful of families in February. I don't know if you were familiar with that. And then also something I don't think you know, but the Family Office Real Estate Institute is going to be housed at the University of Denver. And
wow.
There's going to be certificate programs through the university that also will go toward master's degrees if people want to do that. There'll be executive education. There'll be, it's all focused around that. And so what we're going to do is to really specifically have courses that go over issues specifically to families. So there's going to be talking about what do we do for transferring assets to the next gen, right? How do you go about that with your real estate assets? What type of tax benefits can you take advantage of? 1031 exchanges, 80% of the families don't even use 1031 exchanges, which is a pretty significant number. How do you plan for if the patriarch dies and you've got families that some of the people want to keep the asset, some want to sell, some want to buy a different type of asset. How do you structure that and how do you deal with that? So we're going to get very specific from that, and then also have it tagged on to the Bailey Family Institute at the University of Denver, and plus the law department, et cetera. So that's something that's pretty excited, all educational based. And obviously, like you said, is that, also to help families. The biggest needs are deal flow and due diligence. And I come from the institutional side, working with like Carlisle and Apollo. And so that's where, try to help on that side. And so there's a lot that's, where we can be a resource, happy to help, and would ask for you to tie in. And, it's all educational based. And Angela, since we met, I got to tell you, and I've said this numerous times, I have, can you hear me okay with my voice?
It was breaking up a little bit, but it got better the last couple of seconds.
Okay. Is it okay now?
It sounds good.
Okay. So as I was saying, is that when we first, met, and with your organization that you have, the information that you have in the back of your website alone is worth the price of admission for being a member. It is absolutely amazing. I have yet to come across anybody that has the type of material, information through the videos you have, through the podcasts you have, through the books that you've written, to the white papers. I mean, you've done an absolutely amazing job, Angela, and I do want you to, to know that, and anybody else too that is, wondering, do I become part of the Family Office Association? And that doesn't even include your events. So
well, it's always better when someone else says it than when I say it, but thank you so much. That's very kind of you.
And I got to be honest with you, this is the first time I've been on it, and I feel very privileged and humbled and thankful for having me be a part of this. So.
Well, you're very kind. We're 1:54 to be exact Eastern time now. We may have time for one quick chat question. While that's coming in, I'm going to read a little bit of my sponsorship of my own podcast with my organization. So that takes about 1 minute. I'm Angelo Robles. I'm the host of Angelo Robles' Effective Family Office podcast, and the founder and CEO at Family Office Association, a global membership organization dedicated to families of great success and their single family offices. Yes, we do a significant amount of content and take tremendous pride in that, and do host global events with amazing thinkers and thought leaders, including real estate icons like Sam Zell and many others, Tony Robbins, Andre Agassi, Ray Dalio. We've been very blessed and lucky. Obviously, during COVID, that's a bit on hold, but we adapted. I'm busier than ever, outputting more content than ever, and Monday through Friday, hosting meetings, doing peer-to-peer sessions every other week. And I have a whole bunch of content that I'm kind of sitting on that I'll be distributing this summer, mainly for my members, but some of it will open up a little bit to the public to get them a little bit familiar with what we're doing. But this is a time during turmoil and crisis, not just from a financial, but to some degree a societal perspective, that we want to step up and help and provide value. And I've been very lucky. I have a great team around me, which is growing, and they've been amazing and very helpful. I certainly can't do this all myself, but very kind words, DJ. Thank you so much for that. Many of you know how to reach me, familyofficeassociation.com. I'm very, very active on social media. I already noted our YouTube. It's simply Family Office. And the podcast on Spotify and Apple has been doing incredibly well. And that really goes to the great guest that I've had and some of the marketing initiatives that we put behind it. So I just have to have a decent voice, which I was born with, a good mic and ask a couple of good questions, and I've been very, very fortunate. DJ, you've been fantastic, and what a great subject to cover during the times that we're going through, and one of the most sticky audiences I've ever seen as a live audience in terms of we actually picked up people even half an hour to 40 minutes in and not one person left. So if that's the case and real estate is again so important, make sure to tune in tomorrow at 2 p.m. Eastern, because really with today and tomorrow, it's back-to-back real estate. And we have some really intriguing other real estate topics to come in the coming weeks where we really diversify as an organization. Not to say that I'm Tim Ferriss or Joe Rogan on the podcast, but we got some intriguing guests coming on, of course, DJ as well, but are that level and caliber of people. Again, I've been very blessed and lucky that the podcast is doing amazingly well globally, and I'm very fortunate for that, and hopefully people are getting value out of it during a trying time. DJ, you've been fantastic, but the one thing I don't think you gave yet is for those that want to reach out to you, whether a website or an email, how can they connect with you?
Yeah, thanks, Angelo, because I did want to leave that. And the other thing, too, that I forgot to mention under 4 is that, with this consortium, what we've done is to put together a group that we can invest together as families. And so we can actually look at deals that have gone through the due diligence process. And then for those that are interested, we can come together, and that way we can get better terms, we can get better controls, and where we invest. So keep that in mind. But the way they can get me is DJVK. So David, John, Victor, Keuren at familyofficerem.com. So DJVK at familyoffice, R as in Ralph, E as in Edward, M as in Mary.com. So thank you, Angela, for bringing that up.
Of course. No, it's a pleasure. You've been a great guest. Look forward to the next time and look forward to learning from you, as always, so much about real estate. Thanks for being a great guest. That's DJ Van Keuren, everyone. Thanks to our live audience, those that watch this on YouTube in about a week and in a couple of more weeks on the podcasting stations. Thank you so much. DJ, have a great day.
Yeah, you too.
Thank you.